Passive Pockets is presented by Equity Trust.
What do billionaires do that the rest of us don't? From how they think about risk to where they put their money, there's a lot the ultra wealthy can teach passive investors. Welcome to Passive Pockets, the passive real estate investing show brought to you by Equity Trust. I'm Paul Shannon, and today I'm joined by Bob Fraser, economist, fund manager, and author of the new book, Invest Like a Billionaire, Unlocking the Wealth Secrets of the Ultra-Rich. We're digging into the mindset, strategies, and asset allocation decisions of billionaires and what everyday investors can take away from them. Let's jump in. Bob, welcome to the show.
Yeah, so good to be here with you, Paul.
Thanks for joining us today. I know you've been on the podcast before, but before we dive in, can you just give our listeners a brief overview of your background and what you've been up to lately?
That's a long story because I'm an old dude. Started as a computer programmer. So I'm a UC Berkeley computer scientist, lived in Silicon Valley, started a .com back in the day, and it blew up into, 300 employees. I won the Ernst & Young Entrepreneur of the Year, and then it blew up, and I lost everything, and became a professional trader, stock market trader, and lost everything in the great financial crisis. And at that point, I'm like, you know what? I want to change course here, and I started getting into private alternatives, just realizing that I wanted things with a little more predictability, a little more control. All right. And, I just didn't want anything to do with the public markets. And so started Aspen about 13, 14 years ago with my partner. Turned out to be a great time. We got into distressed debt. So we bought bad debt at a time when there was a lot of bad debt. And we fixed it, and we made a lot of money for our investors. And so we started Aspen Funds like 14 years ago, started with distressed debt, and today have branched out into lots of different asset classes, all private investments.
Excellent. Unique background, and certainly the scars of battle certainly, I'm guessing, have led you to where you are today and given you some perspective on some things. And you recently wrote a book called Invest Like a Billionaire, Unlocking the Wealth Secrets of the Ultra-Rich. What inspired you to write this book, and how did you go about collecting the insights that you share?
I'm super, super excited about this book. A little bit of my story, right? So I lost everything in the public markets. Well, this is where all the normal investors play, right? This is the playground of the normal investors. They do 60-40 portfolios, and if you have a financial advisor, you're in 60-40 portfolios. You know me in it? No, you're in a 60-40 portfolio, but you are. Maybe you're in 70-30, maybe but it's a 60-40 portfolio, and it's dressed up, but that's what it is. They're just so darn flawed. I mean, there's incredibly volatile. You don't have diversification. Even if you think you buy the S&P 500, you're getting 500 stocks. A third of the S&P 500 is 10 companies, which all move together anyhow. Right? You ever notice when the screen goes red, everything goes red? There's no diversification anymore. I can explain why, but there isn't. And I realized the playbook of the ultra wealthy, they don't buy 60-40 portfolios, and they make higher returns and they take less risk doing it. And, so David Swensen, who is the topic of my book, he took over the Yale endowment. He's pioneered this Yale model, and over the course of his career earned 13.1% returns at a time when the market earned 8.8, 60-40 portfolios. Okay, you think, well, that's, a good, 4 point whatever percent. No. It's 4x. 4x. The difference is 400% difference compounded over 35 years. Is that life-changing? Absolutely. And so I'm passionate about getting investors the best deals and having a ride that is much more tame than the public markets and a ride that has better returns with less risk. And so this book needed to be written. There's no book out there like this. It really lays out the billionaire model, how they do it, why the math works, goes through all the different classes like private real estate, private credit, private equity, hedge funds, venture capital, natural resources, infrastructure, what their superpowers are, how they should be a part of your portfolio, the whole thing, how to structure, how they avoid paying taxes, the whole thing. It's a playbook to make the normal guy invest like a billionaire and win like a billionaire. And I'm absolutely passionate about that, having been wiped out by the public markets a few times.
Well, I'm intrigued already. I know from my experience, I've experienced what you're talking about as far as not feeling diversified when I was told I was, right? Well, you put 10% of your stock allocation in mid caps, another 10% in small caps, a big bulk of it in the large cap, broader market, get into some bonds. And then to your point, you see everything go south at the same time. During COVID, you even saw bonds moving in that direction.
Bonds were synchronized with stocks. What the heck?
Right. So no diversification really, right?
And what's happened has gotten worse. So I actually have a chart in the book pre-great financial crisis, a correlation chart of correlations between, value stocks and growth stocks and small cap and large cap. And it's pretty bad. Post GFC, they're like 80 to 90% correlated. And there's reasons for that, because if everybody's buying an ETF, then all the stocks in that ETF are going to move together, right? And if everybody's buying an ES Mini, right, a futures contract, same thing, they're all going to move together. And so what's happened because of there's structural changes that basically mean there is no more diversification. And so you're subject to this full amount of volatility. And volatility is the kryptonite for compounding. It kills compounding. If you go up and down, you experience losses, you are not compounding anymore. And you think you are, you're not. And the key to wealth generation is compounding.
Let's hone in on that a little bit more. This is Passive Pockets. This is the passive real estate investing show. So when we talk about passive income, oftentimes we're talking about real estate related income and, the appreciation that's earned from holding assets for a period of time and then selling them. But in the case of the stock market, when we talk about passive income, there's been this rise of mutual funds that have then gone into ETFs, exchange traded funds, and this sort of idea that you can own a larger piece of the market without taking individual stock exposure risk in these baskets of stocks. And they're easy to trade, they're liquid. The ETFs actually trade during the market, where mutual funds don't actually execute the trades till after the market's closed during the day. But is that sort of phenomenon why we've seen returns muted and why diversification has kind of fallen off a little bit?
Absolutely, because people are trading baskets. And so therefore the basket moves in synchronization. And that's exactly why, as well as the fact that the speed of the internet, and information moves, and everybody has access to lots of information at the same time. That necessarily didn't happen in the 50s, right, or the 60s. So there's a lot of reasons. JP Morgan gave, an analysis of why the correlations are so high, but they just are. And the only way to get truly uncorrelated assets is to go private. And they are not correlated to the public markets. They're highly uncorrelated. And that's the key to return. So there's this guy, Harry Markowitz, who in 1952 came up with this idea called modern portfolio theory. In 1990, won the Nobel Prize for it. And the idea is this, Paul, that if you have stocks A, B, C, and D, and they all have 20% annual volatility, means, on average, they're going to move, 20 to 30% per year. You would expect your portfolio to have 20% volatility, right, overall. And that is, in fact, what you have. But if A and B and C and D are perfectly uncorrelated, you have half the portfolio volatility. So instead of having 20% volatility in your portfolio, you have 10%. And if you add 16 A, B, C, D, up to N or whatever it is, you have a quarter of the volatility. And that means you're compounding better, right? That's the key. So it's all math. It's all math. And but the only way to get it is private alternatives.
Well, you may be preaching to the choir with our audience as far as moving away from public markets into private. So we like that part of the thesis. Now, I listen to a podcast called We Study Billionaires. You ever heard of this?
No.
It's a pretty popular podcast. I encourage you to check it out, but it resonated. It made me think of that podcast when I heard the title of your book, Invest Like a Billionaire. And in that show, they interview a lot of wealthy people, billionaires, and people that are associated with billionaires, and kind of get behind how they think and what's different about them mechanically, but also just from a theoretical standpoint. So in your research and your experience leading up to the writing of this book, besides taking less risk by being more concentrated, I think is what I heard, what do billionaires do differently?
Okay, well, number one, they have 50 to 60% of their assets in private alternatives and 20 to 30% in the public markets, 20 to 30. That is the biggest difference, okay? The other thing they do, so a lot of them, they borrow money. They're not afraid of debt. So a lot of smaller investors I know, a lot of my friends are trying to get out of debt. It's like, debt is a wealth accelerator. And if you're afraid of debt, I'm sorry, you're buying a ticket on the poverty train, okay? Debt is like a fire. Right? It can burn your house down. It can also cook a great steak. So my advice is cook steaks and just don't burn your house down. And so instead of selling positions, they borrow against positions. And in such, they don't have a tax liability. They love inflation. They play inflation, right? People out there are whining over inflation, getting hurt by inflation. You don't like what you're paying at the gas pump. Well, get on the other side of the gas pump, right? You don't like what you're paying in rent. Be a rent collector, right? So billionaires love inflation. They also think of themselves as professional investors. And this is a huge difference. Most of your listeners probably think of themselves as, oh, I'm going to dabble in investing. I'm going to make some investments. If you have $1 billion and you're a family office, you're not thinking about, I'm going to make some investments. You're going to think about, how do I build a great investment company? And that's what every listener should be thinking. How do I become a great investor and build an investment business? Go to the events, and that's all tax deductible, by the way, and you go and learn how to do these things, and you invest to become a great investor. Here's a little math for you. This is an example in the book. So let's say you're a doctor. You're making $400,000 a year. Now, you took 8 years of school. You invested 16,000 hours or maybe a couple $100,000 to get this degree. And over a 40-year career, you'll earn $400,000 a year, 40 years, you'll earn $16 million, right? Not bad. Good investment. You work your butt off, you make $16 million. But if that person would take 20% of her earnings and save it, and she invests it and gets a 7% return, boring, 60-40 portfolio level returns. Over the life of that 40 years, her investments would earn $16 million. Same as her career, which she invested no time to learn how to do. And let's say she becomes a PassivePockets aficionado and studies all this and reads your books and my books and becomes a great investor and can get 13.1% returns. Guess what? It turns out to $84 million. Is it worth your time to learn how to become a great investor, become the CEO of an investment business with your name on it, right? You think of it as an investment business. I'm going to spend time. I'm going to learn. I'm going to go to conferences. I'm going to read books. I'm going to become a fantastic investor. People think it's unattainable. It's beyond them. It is not. Just like everything we've learned, right? We learned. And so you can be a great investor. That's my encouragement, is become the CEO of your money. And that's one of the biggest differences, that the family offices, the pension funds, these guys, they have a business called investing, and they spend a lot of time and effort to do that.
These folks are already billionaires. So if they lose $1 million, it's really no skin off their back. They could take out they could do 4% of the 10-year treasury today. And if they've got $1 billion, they're earning tens of millions of dollars just by taking almost no risk if you believe the federal government is solvent. If I'm a newer investor, I don't have that nest egg. How am I supposed to take away what a billionaire thinks about risk versus what I can actually risk out of my own nest egg, if that makes sense?
It's all about the math. I don't know any family offices that are looking to achieve a 4% return, right? They're all wanting to grow and looking for double digits level of returns. And it's certainly possible. But the math works, Paul, for the little guy too. It's harder as getting started, passive. You have to be an accredited investor, right? Generally, it's very difficult because you have to go active if you don't have the cash. And you can still practice these same things, but risk is risk. If you can go and diversify your portfolio across a few holdings and go private, you'll end up doing way better.
Let's shift gears a little bit and talk about today's macroeconomic environment, because it's a little bit different. There's some uncertainty. There has been for years now as to what's coming down the pike. Is there going to be a recession, et cetera? Are you seeing any differences in how the ultra wealthy are allocating capital given today's macroeconomic uncertainty?
The funny thing is, in my studies of the way they play the game, they're not trying to anticipate the markets. They're playing a diversified game that something wins. So if something's zagging, something else is zigging. And that's the game they're playing, and they're playing the math game. I definitely follow macroeconomic trends. And I pay a lot of attention to these things. And I believe it gives me an edge, right? But it gives me an edge at the margins, right? It's like, hey, instead of making a 12% returns, I got a shot at making 18% returns, right? Over the life of an investment. But ultimately predicting what the Fed is going to do or predicting what geopolitical events are going to happen is a loser's game. You need to build something that's going to survive no matter what, And if, you're going to build a restaurant or a bread company or whatever, you're going to build it to last with whatever the world's dishing out to you, right? And that's the same thing. You should build your investment business that way, is to take whatever is coming and you're going to do well.
Well, certainly, I'm assuming that these folks aren't just going out there and aiming for the highest returns. They're looking for a balanced portfolio that creates some income. There may be some positions that have outsized risks where they're shooting for higher appreciation, but they're probably also looking at wealth preservation strategies. So how do they kind of balance those two ends of the barbell, so to speak? And what are some different asset classes that they're investing in outside of maybe just real estate or private markets?
Honestly, the key is diversification and uncorrelation. That's the key, is to have things that zig when other things zag. And so they're investing across the spectrum and not just in different different stocks, but in different asset classes. And I know your investors are focused on real estate, but why isn't anybody looking at private credit? Why isn't anybody looking at private equity? Why isn't anybody looking at natural resources and infrastructure? These things have a lot of the advantages and have actually some even greater advantages than real estate, and with greater diversification. So the big boys, they manage risk primarily by managing diversification, but they are very risk averse. And, I have a bunch of examples in the book, So let's say, look at a typical real estate investment. You've got the capital stack, right? And you've got the senior lender. Maybe you have a preferred equity lender or position in there. And then you've got the common equity. Let's say the common equity is making, giving you a promise of 15% returns. The pref equity is giving you a promise of 12% returns. But the risk is 100th the risk of loss. I'm going to go for the private credit, right? I'm going to go for the pref equity position personally, right? And I love credit. You take a fraction of the risk, reaching for that extra 2%, you're taking a lot more risk. And again, the math is such that minimizing losses is far more important than maximizing gains. It's far more important. You do the math, put it on the spreadsheet, just take a few losses here and there and compound, and it destroys compounding. It's way, way, way more important to minimize losses. And so the big investors are primarily looking to not lose money. The first thing, Warren Buffett said it, the first rule of investing is not losing money. The second rule of investing is paying attention to rule number one. It really is more important to do this. So I think most individual investors, we're back to the differences between individual investors and billionaires, is much more of a moonshot mindset. Let me just play roulette, right? Let me put all my chips on, red 21 or whatever, and boy, if it hits, but that's not the way big boys invest. They play the math game.
Yeah, I think generically you're talking about risk-adjusted returns, right? And taking less risk to earn the same return, or something thereabouts. So that makes sense. But in the case of like private investments, and a lot of times, if the investment doesn't work out, you could go to zero, right? You could lose your entire sum of money. And a lot of people that invested during 2021, 2022 in multifamily, for example, are experiencing that today, where, floating rate debt was used, rent growth didn't perform, at pro forma. They're in a refinance situation now, and they're finding out that common equity has been lost entirely. So what looks like a hard asset that's going to, be pretty stable and have less volatility, it doesn't have volatility during that 5-year hold period while the debt's, not matured yet. But at that maturity, they find out, we're wiped out here. So how do you balance that? When you talk about Warren Buffett, he's investing in companies, blue chips like Coca-Cola, Berkshire Hathaway, these big companies, they're not going to zero, presumably. So we talk about risk-adjusted returns. With those comments, how does that?
That common equity investment that went to zero, did the apartment complex vaporize?
No, sir.
What happened to it?
The equity vaporized because it was mismanaged.
It's the capital stack is the problem. There was nothing wrong with the investment. It's where you invested, and it's your stupid sponsor. That's the issue. There's a chart in my book from JP Morgan, one of my favorites. Okay, so when it hits real estate. So if you look at public real estate, REITs, right? The difference between the top quartile and the bottom quartile of managers is 1.5 percentage points of return. The second quartile got 6.5%, the top quartile like 7.5% or whatever, right? Something around those numbers. Private markets, the best guys doubled the returns, doubled. The worst guys lost money. This is where you as an investor are going to make or break your portfolio. It's your sponsor selection. And I saw deals, and I put my own capital to work. Thankfully, I did not put any of my investors' capital to work, just mine, in the deal that, 80% first mortgage, 10% pref equity in front. You got 90% levered basically with a bridge loan. You know how that all ends, right? Today, we're investing in multifamily a ton. My company is, but we have a pref equity fund, right? We're investing down the capital stack, and it is just very, very safe. But you want to not over leverage. You want to look at the capital stack, and you want to know what you're investing in. This goes back to becoming a great investor. Take the time to read the PPM. Take the time to break down the capital stack and understand the risk. Do the math on it, right? And it's not rocket science. It really isn't. And the math shows that if real estate is going to drop 35% on average, commercial real estate dropped roughly 35% in the great financial crisis. Okay, so you want to have that much cushion in your common equity at least. So do the math. And I can show you the volatility. I do all the analysis in the book of the whole real estate sector. And basically, there's a couple magic numbers. You don't want to leverage more than 65 to 75%. And as long as you do that, you are not really going to be in danger danger except, if we have nuclear war or something. It's really, you're really not in danger of getting wiped. So it really has to do with sponsor selection and making conservative investments. We had a lot of young sponsors that got, I don't know what happened, like everybody took the, syndications are us course or something and decided to jump into multifamily syndication, people that are really not qualified. And they did deals that, they overpaid, they did debt they shouldn't have bought just because they could get a deal done, and they became good marketers. They knew how to raise capital, but these deals should never have been done. Shame on us for putting our capital to work in some of those deals,
Yeah, there's some accountability on the limited partner side too. If they saw the pro forma projections, they saw the offering memorandum, they could have potentially anticipated that this was a problem, right? And I think that is, I have a few positions in my portfolio where I have to take accountability for those decisions. So I think it pays to get educated.
And me too. In the book, I expose all my own mistakes. I've made every mistake you can make, okay? And my hope is by doing that, by explaining why I made these lousy decisions and walking people through them, that I'll spare someone from doing the same. Right, and save somebody from making a stinky investment, and all my stinkers are my worst, or all my first deals are my stinkers, right? It's like, I'm not doing those mistakes anymore. I saw the red flags at the time. I just chose to ignore them because I like the guy or I like the space or whatever. And, I'm not doing that anymore. What's happened through this process of me writing the book, I'm becoming a much more disciplined investor. I'm investing like a billionaire, which is disciplined. It's paying attention to the math, paying attention to portfolios and allocations, and diversification, these kind of things.
Well, let's go back to the book. What would you say are types of questions that ultra high net worth investors ask that retail investors typically don't? You talked about retail investors kind of shooting for the moon on their returns and getting excited about the flashy metrics like equity multiple on a offering memorandum. But what are some of the questions that billionaires are going into investment meetings with managers on and saying, hey, this is what I need to know?
Having been in the space here for many years on offering deals, if I put a deal out there that shows 18% returns and I put one out there that shows 14% returns, I'm going to get 10 times the interest on the 18, even though it's just a spreadsheet. It's just a promise, right? I can put any numbers I want out there. People don't realize it's just a promise. Okay, so back to your question. Really, what the big boys are doing is they're pulling back the hood. They're asking the questions. Okay, what's your track record for real? Not a selective track record. What's your full track record? Let's look at the depth of your team. So you definitely have a guy that's probably a good sales guy. Okay, but do you have a guy who's doing the asset management? What's your asset management plan? How are you monitoring this investment performance, right? And what do you do? How do you escalate? What's your team? What's the playbook you have when things aren't going well? And who's the team that's doing that? Is there someone with that written over their forehead? It's not just the one guy. They're asking questions like, and I got asked these by institutional investors, right? What keeps you up at night? What are the risks here in this deal? What is your worst deal you ever did and why? And if you don't get transparency, right, you're not looking for perfection. Everybody that's been in this space has made a goof. Everybody. It's just you're looking for someone who's going to learn from it. You're looking for somebody with character. You're looking for someone with transparency. You're looking for somebody who's going to work like hell for you when that deal is going bad. We got one or two, deals that we're putting so much effort into right now, but we're working our asses off and we're not getting paid for, but it doesn't matter. Right? Our investors are our gold. They're our number one, right? That's what you want to know is that, hey, if something does go wrong, they're going to be fighting like hell for you. Those are the kind of questions they ask. When deals really go bad, a lot of times it's the cap table. They're breaking down the cap table and understanding every element of the cap table. What are the terms? Is this adjustable rate? You're going to refinance. Why do you think you can refinance? These kind of things. And asking those questions and really breaking down the cap table to make sure there's no grenades hidden in there somewhere, right?
Yeah, one of my favorite questions is, how are you going to lose my money? Where are the risks and what needs to go wrong for me to lose my principal? Not how great are the returns or what's my preferred return or what's my split, but how am I going to lose money?
Talking about risk. And no one wants to do that, right? But it's more important not to lose money than to make money.
Absolutely. So if I'm a retail investor and I'm getting into the space, I'm kind of new to private placements and I'm looking to allocate into some syndications as an example, what do you think are some key misunderstandings or blind spots you often see from the newer investor?
I think new investors, it's availability bias. So you lock onto the first deal that you come across. You take advice from smart people who know nothing about alternatives, right? So you take advice from your lawyer, your CPA, your financial advisor, your neighbor, right, who's a good tech entrepreneur, whatever. But if you are not a successful private alts investor, you should probably ignore their advice. Smart people make the worst investors, or at least early on, in my opinion, right? Because you're a doctor, you think you're smart, you think you can't mess up, and they do. And so the best thing is to become a listener to PassivePockets and to start to educate yourself. Go slow, right? Start slow. Diversify among sponsors, and your money is not burning a hole in your pocket. Have a no looking for a yes. Your disposition is, this is a no, this is probably a no for me, but I'm listening. Versus the other way is, oh, this is probably a yes, I can't wait to write this check and it's going to be so good, and because we're all optimists, right? Especially entrepreneurs, we're optimists. Optimism is not your friend in this game. We're going to be a cynic and a skeptic. Right? Charlie Munger said, is there such thing as a happy pessimist? He said, that's what I think I am, right? That's what we want to be.
No, I love all that. I know one of the biggest mistakes I made was thinking that the space was smaller than it was, and that I was coming across some generational opportunity as soon as I found this shiny object that was in a beautiful area of a good market, and I had to get my money in before somebody else did. And the fact of the matter is, it's a very vast space.
It's huge, and there's always another good deal around the corner, And I remember, I'm sitting with a friend and he gets a text from one of his buddies, says, I just got $57 million, what do I do? And he's like, we're laughing because we knew what he's going to do is write $57 million worth of investments in the next 90 days, right? And that's just the most ridiculous thing, right? I promise you he's going to be cash poor when the better deals come around next year, and you just want to be just much more circumspect, right?
Cash doesn't earn a lot of money. I know it's not really making anybody rich, but from an opportunity cost standpoint, if you don't have any when there's some ripe deals out there, you'll be sorry you don't.
And there's always something that's crazy good, and like your listeners are probably heavily into real estate. Hey, real estate's great. It's got a few superpowers. One is it's very leverageable, and its superpower is inflation and taxes, right? It's got some real good superpowers. It's not very good at income usually, so they need to look at private credit. If people are needing income, they need to go to private credit. I think a generational buying opportunity right now is in the energy space, in oil and gas. I've never seen prices like this. You're seeing prices down 75% from where they were pre-COVID for buying producing oil fields. There's no geologic risk. There's no drilling risk. These are producing fields. There's only commodity risk. And I've never seen anything like it. We did our Fund 6 last year. We closed it in February and March. It started dividending at an 18% rate. Dividending. That tells you how hated an asset class is, right? And that's a fraction of the earnings. It's earning more than 18% earnings basis. And that's with oil at 60 whatever bucks a barrel. There's better deals out there. So all the multifamily investors are looking at this table in front of them that's, got yesterday's leftovers and it's like barren, right? You don't know there's a table behind you there's a feast on, and that's the great thing about private alts. There's always something that's great. There's always something that's working. That's what you need to allocate to. Right.
Let's talk a little bit about that, because I know Aspen is involved in a number of different asset classes within real estate, oil and gas, and private credit. If you were going to build a portfolio and allocate on a percentage basis into, I'm not talking about public markets, and there's probably room for that in a well-diversified portfolio overall, but let's just take private markets. What are you investing in today if you've got, a blank check, $1 million to go to market with?
I have a $1 million portfolio, what I call the Billionaire portfolio allocation. I have a $10 million and $100 million. And I could pull up the exact numbers, but you're probably 35% in the public markets at $1 million. That's okay. You want, generally, you want that. It depends on your income needs. So if you're older, you want to definitely have a private credit allocation, which has regular cash flows and usually very safe, right? The private credit superpower is being very, very safe and high cash flows.
Is that real estate debt, or is that investing in business debt?
There's several kinds of private credit. Our funds are all real estate debt, yes. But the bigger private credit funds basically lend to private equity companies. Okay, that's where the most of the private credit is coming from, which is a little higher risk, right, than lending against real estate. But yeah, so private credit, you want to have an allocation. So I put real estate as around 25% of your private real estate, 25% private credit, 10 to 15%, and then, natural resources, infrastructure, these kind of things, 5 to 10%. Then you want to have, some cash and bonds in there as well. So something around those kind of numbers.
Well, this has been a fascinating conversation, Bob. I think the next step for the listener is to go out and find a copy of your book. Where can they get one, and where can they learn more about your firm?
So our firm is aspenfunds.us, Aspen like the tree, funds.us. The book, you can go and pre-order. It's going to launch on September 9th. The book is out. But if you pre-order, which helps us out, we've got a whole bunch of freebies for you. So you go to thebillionairebook.org, and go pre-order the book. And you'll get it as soon as it comes out, but you'll also get a masterclass on 7 things your financial advisor will not tell you, and the 7 rules of billionaire investing, a webinar, the Baldr's framework. We lay that out, as well as my top 25 economic picks for 2025 and 2026. So you'll get a bunch of freebies. Thebillionairebook.org.
Thebillionairebook.org. You heard it here. Invest like a billionaire, unlocking the wealth secrets of the ultra rich. Bob, it's been a pleasure having you on. Thanks for your insights today. Enjoyed it a lot.
Paul, great conversation, and best to all your listeners. And may they invest like billionaires and make lots more money and take far less risk.
Whether it's mindset, strategy, or asset selection, there's a lot everyday investors can learn from the ultra wealthy. So a big thank you to Bob Fraser for giving us a front row seat. If this episode sparked new ideas or challenged your approach, don't forget to like, subscribe, and check out PassivePockets.com to join our investor community with a 7-day free trial. Thanks for listening, and as always, happy investing.